Hello, beautiful people. Welcome to another brand new episode of the ITU Forex class. I'm pretty excited about the topic we're going to be talking about today because it's one of those trading strategies that are really simple, and yet a lot of people kind of overlook them because of their simplicity, but they're actually quite profitable when you apply them properly. Okay, so what are we going to be talking about today? We're going to be talking about range breakout day trading strategies. Okay, so in particular, we're going to be talking about one variant of the range breakout day trading strategy. So first things first. What exactly is a range breakout day trading strategy? Okay, so as the name implies, this is a trading strategy that usually defines a particular time bound trading range, which after its formation, the strategy would actually now start looking for trade setups. Okay, so let me give you an example. You see, what we have on the screen right now is a price chart, obviously. Okay, so if we were using something like a range breakout trading strategy, okay, this would look something like, let's say you define the time period you're using for, let me go to a lower time frame to make it easy to explain this. Okay, so this is the 5 minutes chart, and let me quickly add on, what do you call it, period separators, okay, to make it easy to see. Okay, so let's assume the rules for the strategy for you particularly, your version, that's what I meant to say. Let's say you're using from 12 o'clock in the night, midnight, okay, to 3 o'clock in the morning to define your trading range. Okay, so this would look something like this. You see, this is this where we have this dotted line. This is when that 12 o'clock time is going to be. Okay, let me quickly pick my pen and, okay, to draw. So this is when that time period is going to fall. And let's say, like I told you, you've selected from 12 in the midnight to 3 in the morning. That's when you're going to use, so approximately somewhere here. That's the time period you're going to be using to identify the trading range. Now, when we say range, normally we're talking about the distance between two particular points, for example. Okay, that's in this case, this is the example we're using. So between the period of 12 in the midnight and 3 in the morning, this particular currency pair, which in this case, this example currency pair, the GBP JPY, it moved. And the movement it made, it resulted in it forming a low price, which the lowest price was somewhere around here, and the highest price, which was somewhere around here. So now, using this range breakout trading strategy, you're actually going to isolate this price action. That's from here to here, from the highs to the lows, okay? And this is your range. You see where that word range comes from? And basically, what this does is, once you've established your range, once you've established your trading range, the classic example of using the day trading range breakout trading strategy to trade is, once the range has completely formed, you're actually going to place a buy stop pending order at the highest price of the range, and you're going to place a sell stop pending order at the lowest price of the range, so that when price breaks above the highs, the assumption is that for the rest of that trading session, price is going to go up, and so you'd buy. And immediately your buy trade gets opened, you can choose to delete your sell stop pending order, because obviously the direction of the market has been defined and you've already taken a trade. Some other traders, some variant of this trading strategy is that some other traders would leave that sell stop pending order just in case price decides to do a fake out and come to move to the downside. Okay, so they would still have that sell stop pending order, and so in case if price reverses, they would still open that trade. Okay, so moving on. This explanation I've just given you has explained to you the range formation, the time period that we've selected for the range formation, and how the trade setups are identified. Now, there are two options that traders use for trade exits. Obviously, you're going to have a stop loss. So for the stop loss, Usually what the classic range breakout trading strategy does is that once you place a buy stop pending order at the highest price of the range and a sell stop pending order at the lowest price of the range, then your, what do you call it, remind me, your stop loss is going to be placed at the lows of that range. Okay, if you are taking a buy trade, and the stop loss for your sell stop pending orders will be placed at the high price of the range. This covers our exit when price does not move in our favor. How about our exit when price does move in our favor? Well, that is going to be based on you either deciding to use a fixed take profit target, okay, which is going to be like maybe based on risk to reward ratios. So let's say you're trading with a 1:2 risk to reward ratio. Obviously, if you're risking 10 pips, or let's just say 100 pips because this looks more like 100 pips, okay? Obviously, if you're risking 100 pips and you're using a 1:2 risk to reward ratio to trade, then your profit target is going to be 200 pips away from your trade entry, okay? But some traders don't use this technique. What they do is they select a specific time period within the trading day where they are going to close their trade regardless of its outcome. So a very common exit method that traders use is to close their trades in and around 6 p.m. because most of the times the volatility would have reduced considerably by then. And so you establish your range. All these settings that I'm telling you, all these time periods and everything, they are all customizable to you. You can choose to select whatever time period you like, and that's one of the beauties of this trading strategy. The beauty is that no two people who trade with it, except if they actually agree upon trading with the same metrics and same time period, same everything, are going to be using the same thing. You could choose to trade to create a range from 12 midnight to 3 in the morning, and I could choose to create a range from 2 in the midnight to 4 in the morning, or whatever time period I choose. Okay, and then after the creation of that range, basically the way the strategy is designed, after the creation of the range, you're going to place 2 pending orders: one buy stop pending order at the highest price of the range, and one sell stop pending order at the lowest price of the range. And so once price either breaks above or below the range, you're going to have a trade opened, and you could decide to delete the other trade which is untriggered, and then you could choose to have an exit of a multiple of what you're risking, which is like in this case a 1:2 risk to reward ratio. Or you could do what other traders prefer to do, which is to exit at a certain time period in the day. Each one of these methods, just like with any other thing in trading, each one of these techniques has its pros and cons. Let's quickly talk about them. You see, if you're trading with the fixed risk to reward ratio method, one of the pros of it is that when you open a trade, for example, and then price moves in your favor, okay, and then it could go and hit your profit target, and there are days when price will just hit your profit target or move slightly above it, all of a sudden then it's just going to crash down, okay? This particular scenario is going to favor the traders that are using a fixed risk to reward ratio, because if they were not using a fixed risk to reward ratio, then all of that profit that they would have seen would have dwindled right in front of their eyes, and they would have ended the session with nothing. Okay, nothing to show for it. Even though, again, I keep reiterating this in this ITradeup Forex classes that we do, that one single trade should not define your career as a trader. That's not how professional trading is done. Okay, your professional trading has to be based on you taking a large number of trades and then letting your edge, which is your unfair advantage over the market, to play out in your favor. Okay, so the advantage of using the fixed risk to reward ratio method, that's the fixed exit method, is that when price moves in your favor and then maybe reverses against you, then you are actually going to be lucky enough to get a trade that is going to hit its profit target, and you would have exited the market before the crash. The disadvantage, that's the con of using this method, is that there are days when you'd notice that price would blow past your profit target and just keep moving and moving and moving and moving. On those days, you could easily be biting your fingers with regards to, you watching the profits you would have made if you had only held on to your trading position for longer. But you can't have it both ways. Just like with anything in trading, like I keep telling you guys, you can't have it both ways, in the sense that this one has its pros and cons, and the other ones also have their pros and cons. You see, like for the first example, when you're using a fixed exit profit method, in that case, you would have made a profit and then price would have reversed against you. But think about the person who does not use the fixed take profit. He closes at a certain point in time in the day. If he took the same trade you did, then he would have had to sit and watch all of that profit dwindle away right before his eyes. So even though both of you would have traded the same session, you would have ended up with profits in your hand, while he would end up with nothing to show for it. Maybe he traded the day and maybe price might even go all the way down to hit his stop loss. So there's nothing, he even ended up losing money. But you can't have it both ways, because on the days where you made profit, there could be days where he would also make more profits, like just the example I gave you, where price is going to blow past your profit target. You might be happy that, okay, you made a profit of 2 times what you were risking on the trade, but then let's assume this is one of those rare days that you're going to see price blow past your profit target and maybe even go all the way to like 10 times what you're risking on the trade. On those days, you would now start looking at the 2 times what profits that you made for what you were risking. You will not feel content, and you'll be regretting why you didn't just use the other method. But again, you can't have it both ways. You can only pick and choose which method you prefer and go with it. Okay, so this in a nutshell is how the breakout trading strategy really works. To make sure you really understand it, let me quickly bring up the whiteboard so that we could draw this and make it easy for you to understand. Okay, so let me delete all of this. So basically, we have 2 time periods. Okay, so we have the start of the range. Okay, and usually, like I told you with an example, let's say we're using 12 midnight. Okay, and then we have the end period of the range. Okay, when the range is going to end up forming. So we used an example of 3 a.m. in the midnight. So within this time period, price is going to move, it's going to form a high, it's going to form a low, it's going to do all of those things. This is the period we are using to determine our trading range. Now, once this period has ended, then we're going to place a buy stop pending order at the high of the range to get us into the market with a buy trade, a long trade if price was to break above the range, and a sell stop pending order. Okay, a sell stop pending order below the range to get us into the market with a sell trading position if the market decided to break below the range and move in our favor to the downside. The classic way that this trading strategy is traded is that people are going to wait for the range to finish forming, then they'll place a buy stop, okay, at the top half of the range and a sell stop. One variant of the strategy is for as soon as one of your orders get triggered, you delete the other one. So remember, after the range finishes forming, we're going to place 2 pending orders. One buy stop pending order at the top of the range, one sell stop pending order at the bottom of the range. So let's assume it's the bottom sell stop pending order that got triggered because after price finished forming the range, it ended up breaking below. So now you would have a sell trading position and then you delete the buy stop pending order. Depending on the technique you choose to use for your trade exits, if you're using a fixed profit target to exit, which is like 1:2 risk to reward ratio, like I told you in the example, then your stop loss is going to be at the opposite side of the range. And then if the distance between your stop and your entry is like 100 pips, for example, then your profit target is going to be 2 times that distance. Okay, and this is one variant of the strategy. The other variant is for you to trade without a predefined profit target, and then once price has triggered you into the trading position, you wait for a time period in the future, which is like 1800, for example, and then if that time comes, whether you are in a profit or you are in a loss, that trade is going to be closed, and that is the end of the day. So it is a day trading strategy because you close, if you're using this variant where you close your trades at a certain period of time each and every day, it's a day trading strategy because you never leave your trades to run overnight. You create the range at the certain points within the trading day, within the trading session, and then once that trade, if that trades get triggered, then you're going to close it at a certain point in time, and then you are basically not going to have any trades running overnight. That's why it's a day trading strategy. Unlike swing trading strategies where you could have trades which would easily run for a couple of days or a couple of weeks at a time even. So this is basically how this trading methodology works. Okay, so I hope you got it, and that's pretty much all there is to it. But like I always tell you guys, if you want to be profitable in trading, you cannot afford to be lazy. And so you've understood the concept. I've explained how you identify your range, how you identify your entries, how you place them, how you place your stop loss, how you decide to exit, all of these things. But these things are not cast in stone. You can't just come and see me tell you that this works, and without testing it, you cannot have the confidence to trade with it through thick and thin, especially during times when you're going to have those inevitable losing trades. And so that's why it's important for you to go back to the past videos that we've done in the past, where we teach you how to backtest a trading strategy and then backtest it for yourself. Find the one which works for you, find the one which is profitable, and then once you've done that, you can decide to transition from backtesting with historical data to testing on a demo account or testing on a small live account with real money. Okay, so this pretty much brings us to the end of this week's edition of the class, and I look forward to seeing you guys in next week's edition of the class. But before we wrap up, as usual, I would like to use this opportunity to invite you guys to test out our suite of ITU bots, which are expert advisors which designed to take low risk, high probability trading opportunities on your behalf with proper risk management if you follow our risk recommendations. So please, if you'd like to start earning while you're learning how to trade, feel free to reach out to us on any of the social handles, and we'll be more than happy to assist you set everything up step by step as soon as before you even know it. Okay, so once again, thank you for taking time out of your busy schedules to attend this class. I look forward to seeing you in the next week's edition of the class. Once again, have a wonderful rest of your week, and God bless you all. Cheers.